Welcome to the Wealth Studying Podcast. This is episode 451. Today is August 20th, 2024. I'm your host, John Pugliano. I'm also the founder and money manager at investablewealth.com. Well, today I wanted to give you just a quick episode, and I want to touch on a chart I put up over at investablewealth.com. If you're on the blog and update notification list, you should have received an email about that. And everything's archived at the site, so you can always go back and look at those posts for reference. What I put out there today was a chart showing the small cap index, that's a Russell 2000, and I showed it long term over really the last 20 years or so, and comparing it to its long, and I'm talking long-term moving average. Long-term, I mean 4 years, 1,000 days, something along that range. Now, this is a chart that I put up many times before, and particularly quite a bit over the last 18 months or so, or at least versions of it. And the reason I look at this chart so much is because it's one of the two major critical indicators that I look at for determining the likelihood or the probability of a recession or a major market sell-off. The other factor I look at is the Conference Board's leading economic indicators. And if you've listened to me for any length of time, you know I've spent almost all of 2023 citing the leading economic indicators and how they were signaling a potential recession, and really they were tracking at the point where they'd only been previously when we'd been in a recession. There were multiple reasons we didn't go into recession last year, even though the Federal Reserve was definitely trying to create one. They wanted to do that not because they're diabolical. Well, they may be, but that's not why they were trying to create a recession. They were trying to create a recession because they wanted to slow down the economy and specifically rein in rising labor costs. The Fed talks about their dual mandate of maintaining stable prices and maximum employment. I look at that another way, where their dual mandate is to create stable labor costs with maximum inflation. But that's another story. In any case, I really believe last year the Fed was trying to create a recession. So far, we're more than halfway into the year. We haven't had a recession, and I think it's very unlikely at this point that we're going to have one this year, and especially not before the election. Now, black swan events, things can happen, but for right now, for a multitude of reasons, I think we're not going to have a recession. That's why I've been buying stocks. And we can get back to those two factors that I talked about. The Conference Board leading economic indicators and the small cap stock long-term moving average. Both of those factors have been improving. Now, we're not out of the woods yet. There's still a lot of sketchy red flags and things that are evident in the Conference Board's leading economic indicators. Things like new orders are slowing down. Unemployment is moving up. The economy is definitely cooling down. Okay, but all that doesn't necessarily mean we're headed into a recession. Could be just a slowdown. And also, I think that the Federal Reserve has a lot of firepower right now that they could throw at any type of a slowing economy. The Federal Reserve has their overnight funds rate at about 5.3%. That's pretty much the highest it's been in at least, 23, 25 years. So should the economy slow down below the rate that they want it to grow at, they can drop interest rates faster than a congressman can lose his character. So they've got a lot of tools in their toolbox. They don't have to just cut that at 25 basis points. They could knock off a whole 50 or 75 or drop it even lower all at once if they wanted to. They've got plenty of dry powder to fight the next recession with. So even if things do slow down this year, I think that they can counteract any recessionary problems, and it wouldn't be that we wouldn't officially fall into a recession, but I just don't think they're going to let it be prolonged. It doesn't fit their interests right now. And then, of course, there's the long-term generational type trends that are in place that I won't go into now. You've heard me talk about them a million times, but we continue to see an expanding U.S. economy because of things like demographics and lower energy costs and technological improvements in improving productivity and onshoring and nearshoring and shoring up the overall supply lines, which is bringing more manufacturing back to the United States. This is a trend that's been going on for at least the last 10 years, and it isn't losing momentum. But I digress. Take a look at that chart that I put up over at investablewealth.com today. It shows you the Russell 2000, that's the small cap index. That's the most fragile part of the major indices. It's why I keep an eye on it, because it can be the canary in the coal mine to give an indication that the bottom is about to fall out of the economy. And for right now, it's been showing consistent improvements for multiple months now. It's staying above that long-term 1,000-day-ish moving average. The reason that's important is, and again, if you look at that chart, you'll see that there's very few times that the index goes all the way down to that moving average, and even fewer times when it breaks below it and stays below it. And really the only time that we've ever gone into a long recession or a protracted downturn in any of the markets, it occurs whenever the small cap stocks drop down below that long-term moving average for any length of time. Again, that's why I was so concerned last year, because again, take a look at that chart. And from about the summer to the fall of 2022, all the way up until the fourth quarter of 2023, the small cap stocks either were only slightly above that average or they were below it. And to my knowledge, that's the longest time in history that something like that occurred when we didn't get a major stock market crash or when we didn't go into a recession. But again, in any case, it looks like small cap stocks are recovering. Now, we have to be cautious here. I'm not telling you run out and buy small cap stocks. You're not seeing me do that. I'm very selectively buying stocks that I think are undervalued, or at least trading at a fair value and have the potential to grow at a higher rate. I call that growth-adjusted valuations. Now, some of these are small caps that I'm buying, but by far the most of them are mid caps to large cap stocks, and just a good chunk of them continue to be in the S&P 500, even if they're smaller-ish type companies. That's just where the stability is. The problem with small cap stocks right now, as has been the case since the pandemic, is that you have something like 38% of the small cap stocks are not profitable. They're zombie companies. They couldn't make money over the last decade when interest rates were at or near zero. Now I believe we're in a higher regime of interest rates. And so I have to scratch my head and say, if these companies couldn't be profitable when they could borrow for free, how are they going to be profitable when high risk, distressed junk bond zombie companies' debt is trading at 6, 7, 8 or more percent? But I don't know. We'll see. The Federal Reserve can't let 40% of small cap companies go out of business. And so I think just like the housing crisis took, more than a decade to resolve, I think this small cap zombie companies are going to take the next decade or so to resolve as well. And it actually isn't a factor affecting the overall stock market. The Russell 2000 small cap stocks, okay, and there's not really 2,000 of them, there's less than that now, but somewhere in the neighborhood of 1,900 stocks make up that index. From a stock market capitalization standpoint, they're very minimal. Although there's, 2,000 stocks, if you add up all their individual value, they're less than the big cap mega stocks. And I'm talking individually. So Apple, just Apple itself, has a greater value than all the 2,000 small cap stocks. And so does Nvidia and Microsoft and on and on. So it wouldn't be the end of the world if there was a major correction in small cap stocks from a stock market point of view. My concern has always been with the small cap stocks is that that's where a great number of people are employed. One of the reasons that companies like Apple and the other mega cap stocks are so profitable is because their worker productivity is through the roof. They make billions of dollars of profits with just a very small workforce. That's why they've earned so much incredible money over the past 15, 20 years. Again, this is a benefit of technology and of improving productivity. And that's much less the case when you get into small cap stocks and small companies. So what I'm saying here is that from the financial markets, the small cap stocks and small business isn't that important. But it is crucially important to the overall economy because far more people work for small businesses and private companies and Russell 2000 small cap companies, and I'm talking tens of millions of more people, work for those smaller companies than ever work for the Fortune 500 and the bigger companies. So when you see a lot of small cap companies or smaller private businesses going out of business, you want to be concerned about the health of the overall economy. But again, for right now, even though bankruptcies are at some multi-year highs, they're not crazy historically high. And I think the Federal Reserve is going to do their best to use their interest rates and their money printing capabilities to keep enough of these small cap companies alive to stabilize the economy. And again, that's exactly what they did in 2008 when it came to housing. The Federal Reserve did not let the economy nor the housing market totally collapse. They came in and they bought mortgage-backed securities, and this was the first time in history they had done that. And it's always been questionable whether that is even legal or not, but they went in and bought mortgage-backed securities just like during the pandemic when they were throwing out helicopter money. They said that they would, if they had to, go in and buy direct junk bonds from individual companies. Again, something that's never really been done by the Federal Reserve's balance sheet before, but they said they would do it if they had to. Just think back a little more than a year ago, March, April of 2023, during the weekend when the banking crisis occurred. 3 banks went out of business. The Federal Reserve stepped in over the weekend and usurped any previous laws or precedents by saying that they would not only guarantee private individuals but also businesses' deposits at banks, and not only up to $250,000 or any preset amount by FDIC insurance. They said they would come in and guarantee all deposits 100%. That stopped the banking crisis in a weekend. The Federal Reserve has a lot of tricks they can pull out of their hat. They're currently this week up at Jackson Hole, Wyoming at a meeting. We'll see what comes out of that meeting in the next day or two. I'm sure they're going to take a very dovish approach and pretty much solidify that there will be some kind of a rate cut in September, and if not, something following that in November and December if necessary. So, hey, again, 2 weeks ago, everybody was panicking, losing their mind. The volatility index at the VIX spiked up to, I think it was 68. Basically went from consistently being around 12 or 13 to getting up around 15, and then all of a sudden, boom, skyrocketing up to that high 60-something level. Something that has only happened a couple times during the pandemic and going all the way back to the 2008 housing crisis. And so a lot of people, the gloom and doomers, came out of the woodwork to tell you that everything was going to fall apart. And even with the VIX, and this again comes back to the strength of the U.S. economy, even with the VIX skyrocketing to be in the high 60s, a near unprecedented event. What actually happened with the market? Well, even with the small cap stocks being the canary in the coal mine, the most volatile of the indices, they never even got down to their 200-day moving average, and they never even had an official correction because they never got down by 10% or more from the recent 52-week high. And of course, the mid-cap stocks, the S&P 500, they performed even better during that major spike in volatility. Now, I'm not saying we're all clear here. When you look at the calendar and the seasonality, July through October are always the most volatile months within the stock market. And of course, this is election year mental illness. And so we're probably going to see a lot of bumps and a lot of volatility between now and the election. But for now, unless something changes materially, I'm going to look at those as buying opportunities. I don't have any plans to sell anything I have. And if we do get some dips that I can buy, I'm going to buy those. And if we don't, I'll probably buy some more anyways. I think that under the surface, even though something like the S&P 500, which has been held up by the mega cap stocks, under the surface, there's been an extreme amount of movement. And those dips in those individual stocks are potential buying opportunities to me. Well, hey, there you have it. I hope you're enjoying your summer. Until next time, as always, this is John Pugliano wishing you the very best returns.